you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Hello, everybody. This is Harold Green of Bright Tree Wealth Management, and it is time to stop doing what you hate. Hopefully, you folks are having a fantastic day today. It's Friday for me, and doing pretty good. Had a very interesting week, and I kind of been thinking about what I really needed to share with you folks, or what to educate you on, because it is always my goal to educate you and to seek the truth and to deliver it in a way that that makes a lot of sense and that will help you understand what's really happening, what's really going on. And today I want to talk about something that not too many people know how to properly explain to clients. And it's a big compliance issue. And I think we really got to get this thing sorted out. And what I want to talk about is the risk tolerance questionnaire. And the title of today's show is Understanding Risk Tolerance, and basically what it means to you. And I've studied this risk tolerance thing a lot. We have software that helps to qualify a client in regards to the type of portfolio they should be in. But the thing I find the most disturbing is this. Most risk tolerance questionnaires are mostly a mental and emotional issue. It has very little to do with a client's long-term financial plan. And herein lies the problem. Most people do not invest according to a well-balanced, comprehensive financial plan. And because today is an investment show, I am going to say past performance is no indicator of future results. And if you are going to invest, you do have to understand risk tolerance and time horizons and all of these different things. But I'm going to say this: it has to be done according to a financial plan that has inflows built into it, that has outflows built into it, that has what-if scenarios built into it, and a variety of other factors that are built into it, because that right there should determine the type of investment plan, not your emotional issues. And there is the problem. I've talked to a lot of people, and they say, they're about to retire or they're getting close to retirement, and they're like, Harold, this is all I got. And I'm like, why is that? Well, the person I was working with, they didn't do a good job, or I've been so conservative, I worry a lot about stuff. And I'm like, well, you probably are worried because you don't have a plan. You don't have a step-by-step hand-holding type of situation that's there with you that you can refer back to whenever you start feeling a certain kind of way about the market. So today I'm going to walk you through a simple questionnaire on risk tolerance, and it's going to be mixed with facts, and it's going to be mixed with emotion. And I'm going to tell you where it is, where the facts are and where the emotion is. Okay. The first thing you always start with in a risk tolerance questionnaire is like, how much time you got? What's your time horizon? And there are a lot of rules about time horizon. And this is one of the biggest mistakes that people make. And I'm going to go through here and explain to you what that is. Question number 1 says, where are you in the investor life cycle? In the investor life cycle. To me, there is no there is no cycle. It's you do this until you're dead. Like, you pass on and then everything goes to your family. And then that's going to carry on. That's where the plan comes in. And here are the choices to answer. You're either in the early accumulation phase, where you got greater than 20 years to retirement, mid accumulation phase, where you got 10 to 20 years to retirement, pre-retirement, you got less than 10 years before you retire, or you retired 10 to 20 years after retiring, or late retirement, you're 20 years plus after retiring. And a lot of people come to me and they're 50 years old or 51 years old, or they're in their 50s, and they're like, hey, I want to retire at 62. I want to retire at 65. I want to retire before 70. What do I have to do? Where am I in this cycle per se? And one of the things I look at and I say, well, here's the real question. How long do you plan to live after you retire? And I say, we don't know. Well, how long do you want to live after you retire? I don't want to live until I can't really do anything. And I said, here's the thing. Anybody who works with me, I'm looking at them living at least 30 years after they retire, at least 30 years. So if you come to me and you're 55 years old or you're 60, 30 years is 90. And so the problem is the rules and stuff like that, or the norm says, well, if you're retired, you shouldn't be aggressive and so on and so forth. You should be more conservative. Why? This is what's hurting a lot of people. They're getting advice because of a lot of different things. Because normally, and I'll get into this in a little bit, they say, well, when you retire, you got more time. You're looking at your portfolios all the time. You see it go up and down. That makes you nervous. That's an emotional issue right there. Has nothing to do with the facts. That's pure emotion. And I'm just going to like pace myself because there's a lot in this. Question number 2, how long do you need funds to last once you begin making withdrawals from your investment accounts? It says less than 2 years. I don't know why that's there. 2 years, 3 to 5 years, 6 to 8 years, 9 to 10 years, 11 years or more. The correct answer should be 30 years. You should be looking at taking funds from your investment account for the next 30 years. Also, there's RMDs at the 72 number. They're going to bump that up to 75. You should be looking at 30 years, depending on your situation. And I'm going to leave it at that. Section 2 goes into the more emotional side of the risk tolerance questionnaire. Number 3 is your level of investment knowledge. The answer is none, low, medium, high. And here's what I'm going to say. People who say I have none, I have no investment knowledge, that's not true. Everybody has some level of investment knowledge, some level, whether it's a little or it's a lot. And even if someone comes into me and they say, yeah, I have a high level of investment knowledge, I think the real question should be this. What is your level of investment experience, right? What have you gone through when it comes to investments? Have you made money? Have you lost a lot of money? What have you tried? Did it work? Did it fail? That should be the real question. Because again, some people know more than they think they know. And people who think they know a lot, they know very little because it's not really based on your level of investment knowledge. It's just based on your level of experience. And I'm going to have that question in my questionnaire about experience, not what you think you know or what you don't know. Number 4, which statement do you identify with the most? This is an emotional question. Everybody identifies as something. And here's where it gets a little murky. Your identity should have nothing to do with your investment strategy. Your investment strategy should be based on your financial plan, not your identity. Well, I'm comfortable earning lower returns if it means taking less risk because, my dad, he used to invest, he lost money, and my mom, I saw her losing money, and my friend lost money, and that just made me conservative. I don't like losing money. So if I got to take a lower return just because I don't want to see the risk, I'm fine with that. The question is how does that look in your financial plan? You're taking less risk, but you have all these goals and things that you want to do. Where's the money going to come from to fund that? Now, if you have other monies like a pension or something coming in and you can just like knock it all out with your pension money, yeah, then you don't need to take that kind of risk. Then I'm okay with that. Number 2, I'm comfortable taking a moderate amount of risk to earn moderate returns. I'm comfortable taking more risk to earn higher returns. Here's the truth. You should never be in one of these positions all the time. I'm going to say that again. You should never be in one of these positions all the time. There are going to be times in the market where you could find yourself in each one of these modes. And I'm going to give you an example. When the market gives you opportunities to earn a tremendous or potentially earn a tremendous amount of money, and you're comfortable earning a lower return because you're taking less risk, you're missing the whole point. You're missing the whole boat. You can say, hey, all right, this is where the market is right now. We're going to take this kind of risk because the potential returns are this. It's basically 5% versus 30% in a year. Once you earn your 30%, it's okay to cash in your chips and go back to being conservative mode when the market changes. The problem is too many investment advisors are not accurately explaining this because they have the client in a particular type of a portfolio. It's either aggressive, it's either moderate, or it's either low risk. Because the client answered the questionnaire and they say they're low risk. I don't want to get in trouble. I don't want them calling me all the time. No, you're doing the client a disservice because you're not properly explaining what the opportunities are that are out there because you're not taking advantage of the opportunities yourself as the investment advisor. That's a problem. Number 5, what is your primary goal for investing? Says circle 1. Avoiding loss, even if it means accepting lower returns. This is emotional. Hedging against inflation at risk levels I'm comfortable with. That doesn't work. That doesn't work. Hedging against inflation at risk levels I'm comfortable with. Wait a minute. If inflation is 3% and you're only comfortable hedging against it at 3%, you might run out of money. You might hit what they call portfolio failure. This is an emotional issue. Increasing portfolio value at a steady pace. This is honest. And some people say, okay, look, a steady pace. What is a steady pace? As long as it's trending upward, I see that as a steady pace. Or it could be down 1 year, up 1 year, down 1 year, up 1 year. But at the end of 5 years, you're up 20%, you're up 30%. Is that a steady pace? Again, what does the financial plan dictate? A steady pace or the tortoise and the hare approach? Like the hare, boom, you run, you knock out the race, you chill. The problem with the hare is he thought he had won, but he he ran too fast and he slowed down at the end or wherever he was and he just fell asleep. We don't do that. The last answer is earning the highest possible return regardless of the risk. What if the financial plan dictates this for a period of time? Earning the highest return possible regardless of the risk. What if that's necessary for your situation? What if you come into me and you only have $300,000 and you're 60 years old and that's all you have? What do we do between now and 65 or 70 or whenever? And I was talking to somebody the other day and, we were talking about risk tolerance and trying to find a better software scenario to help us dictate and determine how to help clients understand this. And I told them about the Rapid Retire program because, we're talking about risk tolerance and they're saying, well, if the person is low risk, then they just have to keep working. I said, what if they can't work? What if they get sick? What if something happens? What if they're forced out of the workforce? They can't. So we have to generate these returns. We have to find opportunities to generate the highest possible return. I'm not going to say regardless of the risk, because that's a crazy thing. That's foolish. You have to understand the risk involved in the investments. This, again, is an emotional thing, and this is more like gambling for some people. This is to help determine whether or not a person is a gambler or not. They're taking unnecessary risk. That's what the financial plan is for. Question number 6. Increasing market volatility results in a 20% dip in your portfolio. How do you proceed? Emotional. Immediately shift to a more conservative asset allocation to minimize the potential for additional losses. Wait a few months to see if the market shows signs of recovery before making a pivot. Buy more shares when prices are low. Do nothing. Your action should be based on the financial plan. Okay? It should be based on that. And it should be based on one more thing. And I'm going to tell you what that is towards the end of this conversation. Okay. Number 7, which risk reward profile is most attractive to you? Assuming a 30-year investment horizon, it used to say 5-year, but I changed it to 30. Again, this is emotional. Which risk reward profile is most attractive to you? To me, it doesn't matter. It's what does your plan dictate? What do you need? What type of returns do the plan need? Here are the answers. Portfolio number 1, potential gain of 20% for a potential loss of 8%. There's a spread there. Number 2, potential gain of 25% for a potential loss of 13. Then it goes for potential gain of 30, 20 for a loss of 21, potential gain of 33 for a loss of 27, potential gain of 37, potential loss of 34. What if these numbers were wrong? What if there's a potential gain of 100% and a potential loss of 34%? What if that was true? What if there are positions out there that could do that for you? What if? And I'll explain something towards the end of this. Should not be what's attractive to you. It should be what's possible. Is 100% gain with a 34% loss possible? Yes, but it's going to depend on how active your manager is. Number 8, what are you most likely to focus on when monitoring your portfolio? This is a good one because this is mixed with emotion and facts. Okay. Number 1, are you going to focus on investments that are underperforming? Like, you put that in my portfolio. It's not going anywhere. It hasn't done nothing. And then you call and say, I want it gone. Next month, it goes up 30%. Now what? Number 2, you focus on investments that are overperforming. Yeah, Harold, that thing is, that's on fire. I love it. Add more to it. Overall portfolio performance, short term, are you just looking at the short term? Harold, I'm down 10% over the last month. What's going on? Overall portfolio performance, long term. Okay. This is where it goes back to our plan. Our plan dictates what we should be focusing on. Number 9, which is more important to you? Generating consistent income from your investments with relatively minimal risk. I'll tell you honestly, I don't take on these kind of clients because, again, it's the mindset. If you're trying to generate income, most likely I'm not going to take you on unless it's a specific situation because this is not what we do. And so I've generated portfolios for clients that did come in and say, hey, this here happened. I inherited all this money. I want to just park it over here. But normally those people are already clients. Okay. And I'll do that for them. But people coming in off the street, I normally don't get those people. And then if I do, I really have to question whether or not I'm going to take them on because they're nervous Nellies for the most part. And it's not going to go well with the relationship. Number 2, growing your portfolio's value while also generating income. And then growth only. Here's the problem. If you're in an actively managed portfolio, the goal is to generate as much growth in the portfolio and then be able to withdraw as much as you're going to need. The whole income conversation shouldn't really be a part of this, but because this right here is an investment person, this is a client's makeup. This is all about the client's makeup. Like they don't want to lose, so this is kind of telling me that, hey, this person is super conservative. As long as they can get, $3,000 a month out of this thing, they don't want to be taking all that risk. I really don't have those people on board as clients. I really don't. 10, which scenario worries you the most? Loss of principal. Again, which scenario worries you the most? Investment returns that don't keep pace with inflation, underperformance that leads to portfolio shortfalls, mistiming the market. And this is an honest question. It's an emotional question. And a lot of times people worry because they don't know what to do. And one of the things that we do is we try to educate our clients, we educate our clients so that they shouldn't have to worry. Because if you're sitting there worried, what the heck did you hire me for? You're going to hire me and then you worry, what do I lose sleep for? I'm wasting my time if you're going to worry. And then now I'm like stressed out. I'm trying to do my job and I got all these things on my plate and I'm trying to take care of. And I know I'm going to be writing your portfolio, but you're just so worried. And again, it's because there's something that you don't know. That's what worries you. We don't understand what the plan is. We don't understand what the action steps are. And I'll get to that in a second. Number 11, which scenario would allow you to take more risk in your portfolio than you're normally comfortable with? This is a very important question. And I think right here, and I'll get into it in a second, but this is important. Here are the answers. My investment manager actively checks trades in my portfolio often. Like this guy's on it. Number 2, my investment manager sends out quarterly updates explaining our current investment strategy, what's going on, why it's happening. Third answer, I have bad spending habits and I may outspend my current assets. So I got to take more risk that I'm comfortable with because I'm wasting money. I'm spending too much money. The next one, periodically, I must have family members. Like my family is poor. They don't have money. So I'm always having to help them. And so if I'm sitting here in conservative mode and my portfolio is not generating enough money and I'm helping my family, then I'm going to run out of money. And then we're both going to be in a bad spot. So I gotta put the foot on the gas. And the last one is my investment manager has a track record of making up losses in 12 to 18 months. Which one would allow you to take more risk in your portfolio? This is where it is. And so I tell clients all the time, hey, look, it's not if we're going to lose money or not. It's not that. You're going to lose money in the market. That is a guarantee. In the stock market, you are guaranteed to make money. You are guaranteed to lose money. The question is you want to be which side? Okay, so you have to balance it out so that you're taking the risk and you have to get in the positions that over time are going to give you the returns that you're going to need. You got to balance out the ups and the downs because your portfolio is going to go down. That's guaranteed. I know that for a fact because I see it every day. The stock doesn't just go up a cent a day or 2 cents a day. It's up $1. It's down 5. It's up 10. It's down 20. It's up 30. And so some of these positions are volatile. And the question is if we get into a rough patch in the market, like we did in 21 and 22 and 23, if bad things happen in the market, the question is what do you do? Do you do nothing? Do you buy more? What does the investment strategy dictate? Not what you are comfortable with, not what your emotions say you should do, but what does the investment strategy dictate according to the financial plan? And a lot of times, Warren Buffett says buy low, sell high. But a lot of times people aren't comfortable with that. So guess what they do? They sell low and they buy when things turn around. It's an emotional disaster that happens all the time. So I share with my clients, look, how long have you been with me? 10 years, 15 years, whatever it is. Every time your portfolio went down, how long did it take us to make it back up? Some clients say, Harold, it was like 3 months. I looked and then I looked again. And the next quarter, I was back to where I was the quarter before. Did you panic? No. Why not? Because the strategy does not allow for me to panic. If I panic, that hurts the strategy. Again, so what we do for our clients is I tell them straight up, when we know that our theme is accurate and we're on the right track, regardless of what everybody else they're saying, we are adding in and layering into our positions as they go down. Why? Because I know the selling is purely emotional, it's algorithmic. The computers are selling. When they sell, it looks bad. Then the people wake up, then they start selling. And then sell first, ask questions later is what they do. And so what happens is they sell the hell out of a position. And then a week later, everybody wakes up and says, hey, this thing is on sale. My God, it's cheap. Let's pile back in. It's like, what? So while they were all piling out, we were layering in. So we have our place in line. So when they come running back and they want to buy it back, because now the news says this about the stock and the media says this about the stock. Now they're running back to buy it back. This is where we make our clients, that's the potential for us to make our clients the most money they've ever seen in their entire lives. Because we teach them not to panic. And what does their investment strategy allow for and what does it call for? Sometimes people get emotional and they call me and they say, hey, I can't stand this anymore. I don't want to do this anymore. That's absolutely fine. At that point, 9 times out of 10, we part ways because I don't care what they do. When they leave, look, they still got to live. They still got to retire. They still got to invest or do something, right? Or they have to cut back their lifestyle so drastically that they're just so frugal. They don't want the risk. They become like so cheap. They're like unbearable people. Like they don't go out to eat. They don't do anything. They're just existing because they've been burned emotionally with the whole investment strategy because they didn't understand how their plan should dictate the strategy. And then the strategy dictates what we buy, what we sell, when we buy it, when we sell it, not an emotional response. And the last question is, where do you get most of your investment news? From coworkers? From cable news? From social media? From investment software sites like Motley Fool? Most people get their investment news from social media and cable news. The 2 worst places you can get investment information. You know why? Because everybody has a narrative that they are trying to sell or a point of view that they are trying to get across. And there's hardly any time to go into the fundamentals behind it. There's very few shows out there where they dig into the fundamentals and they begin to like get into the, corporate structure, who the CEO is and the business model. And do they have good management teams? Very seldom. You just hear people's opinion. And a lot of times their opinions are based on their politics. So this is why it's a disaster to get your information from the wrong sources. And this is why for me and my firm, every 2 weeks, we put out update to our clients explaining, hey, here's what's going on out there. I know you heard this. Here's what this means. Is it good or bad? When a CPI report comes out, man, inflation is it's going to go up. It's going to go on the rise. And so therefore you get emotional and you start to panic based on what somebody said in the media. That's crazy. We have to turn back to the plan. Your plan calls for you taking $40,000 out a year to travel for 10 years. If we start going conservative at the wrong time, when we should be the most aggressive, then you might have to cut that trip back to like 10,000, 10,000 coming out. This is where you don't change the strategy unless you change the plan. So today I wanted to help you understand risk tolerance and the facts and the emotions behind why people do what they do, how they might even answer these questionnaires, how the way they answer these questionnaires could be detrimental to their long-term financial goals because they didn't understand whose role is what. Now, I'm going to explain this. As a client, your role is to get yourself educated with me, understand what you're supposed to be doing when you're supposed to be doing it. My goal is not only to do my job, but to explain to you why I'm doing what I'm doing and why we should be taking this kind of risk or not taking this kind of risk according to your plan and your strategy. That's very important. So therefore, we are a perfect team. When we work in harmony like this, when the market goes down, you see me buying. If the market goes down and you don't see me buying, one of two things are happening. Either I believe that the selling is going to continue, or I'm lazy. I'm not doing my job. If I don't buy, it's for a particular reason. It has to be for a reason. And the only reason is I think it's going to go down more. And I have to explain that to you. Hey, we're not going to buy right now. We're going to rotate here. We're going to do this and we're going to wait because I think it's going to go down more and we'll have a better entry point to come back in. Otherwise, you're going to see trades in your portfolio. And if you see trades in there, even though the position is going down, it means I believe that the selling is short-lived and the buying is going to pick up in a month or two. And so therefore, we're going to layer in as the position gets cheaper. That's what we should be doing. And so I just wanted to share that with you guys today. Understand risk tolerance, how it ties into a financial plan. If you think you've been educated wrong on risk tolerance and you want to talk to me a little bit more, get on the calendar, go to the website, request an appointment, and we'll be sure to talk to you and help you get this thing straightened out. Because too many people are sitting in underperforming portfolios because they have the wrong idea about risk tolerance. So thank you for allowing me to share today's show with you. And until next time, everybody, 1, 2, 3, let's get it.
This is the podcastfactory.com.